Alright, welcome to another run through of the top 5 charts of the week. This is the free email that goes out to subscribers of the website. So what we're going to do in this video is just go through all 5 charts and add a little bit of extra comments and context around them. So we'll just get straight into it. The first one here is really quite an interesting chart. It shows you in the red line speculative futures positioning in equities, and so that's aggregated across all US index futures. And the way it's showed here is a net non-commercial futures positioning, so longs minus shorts divided by open interest, and then I've taken the Z-score just to put them in common terms here. And then on the black line there, it's 10-year treasuries. So basically it's in the red line stocks and the black line bonds, and traders are basically very long on equities and very short in bonds, and you can see there in the spread between those two that's sitting at a record high, at least for the period that's covered here. So what really is this telling us? It's basically telling us that traders are doubling down on this trade here, because if you think about it, a lot of the times, but not all the time, stocks and bonds tend to trade inversely. So what's good for bonds is usually bad for stocks, and what's bad for stocks is usually good for bonds. And to illustrate that point, if you're expecting higher growth and inflation, that's usually consistent with higher bond yields, and higher bond yields is another way of saying that bond prices are going down. And better growth inflation outlook is typically bullish for stocks, because it means better earnings growth prospects. So basically you've got the market here, traders really doubling down on this whole view that growth and inflation picks up from here, which is probably a fair view, but if there's a bit of latent pressure building up here, and if they're wrong, then there's going to be a lot of scrambling to cover those positions, aka volatility. Number 2, US dollar is becoming a crowded trade. So this red line here shows you, again, it's the same kind of indicator we just looked at. It's a speculative futures positioning. And around the turn of the year, it was quite short. And that was the point there where, I was looking at this chart as well as some breadth charts which showed bullish divergence and solid yield support on their yield indicators, and even a bit of a pullback in valuation, and that helped pick the turning point there. But at this point, the market's slowly moving over to the crowded long side of the spectrum here. And when I think of positioning, I think of it as it's good information on where the market's positioned, and that sort of can tell you about where the future buying and selling is going to come from, but also carries sentiment information. And with all sentiment indicators, the rule of thumb there is that through the range, so at the moment, as it's going up through to the top end of the range, it carries momentum information. So at this point, it's pretty strong bullish momentum. And when it gets to an extreme, it rolls over, then that's kind of contrarian information. So at this point, and like traders here have actually been pretty on the money in previous run-ups here. You can see when it moved up, it's very strongly there, and I think that's 2008. That it was followed by a big rise there. Same thing in looks like 2010. The dates are a bit spaced out here, but particularly in late 2014, when this really big move got underway, when it went from 80 to 100. The market did go from short to long and then longer. So as I say here, it's becoming a crowded trade, but that's not necessarily a barrier to further upside. My base case is US dollar gets stronger from here. And it's going to be very important for this next one, which is EM, emerging markets risk pricing. And what we're seeing here is on the left hand side, credit spreads for EM corporations, and on the right hand it's the median sovereign credit default swap indicator there. So basically you've got corporate credit risk pricing on the left hand and sovereign or government risk pricing on the right hand. And there's been a big turnaround earlier this year in risk pricing for emerging markets. I think, you go back to the dollar here and you can pretty much trace it to that. Dollar goes up, EM risk pricing should go up because it tends to put stress on emerging markets, tends to tighten EM financial conditions. We did have a little bit of a pullback in risk pricing on both fronts there, a bit of a relief rally. There's a couple of things driving that, just the top out in the US dollar there, bit of stimulus chatter from China, but I don't think that either of those things are going to be enough to really put a sustainable lid on the risk pricing here. My base case is that, if we do get the stronger US dollar, then that's going to flow through to a bit of extra stress on emerging markets, particularly with the Fed continuing to hike rates and proceeding with quantitative tightening. Number 4, active versus passive fund flows. So big news last week was Fidelity dropping the fees on its new index funds to 0. So there was a bit of a lot of pressure on fees. I think more recently, but particularly over the last, I would say 10 years at least, there's been a lot of pressure on fees for managed funds, and particularly in the passive space. I mean, if you think about a passive fund, it's not that expensive to run. It's not that much value add. I mean, all you do is get a spreadsheet, and it's pretty easy to administer from there. You just look at what's the biggest companies, and you buy, allocate the portfolio based on the weighting of the market caps. And the only time that you're really trading is when you have inflows and outflows. So it's pretty. I guess it's in a way logical that you would end up at that point, and from their perspective, there's other ways that they can kind of get economic value out of that. So very interesting, and it's a win for investors really. But in terms of that actual chart, it's just showing a bit of a bit of an excuse to roll that out really, is so looking at passive and active fund flows, and there's pretty one-way traffic there. Last one, number 5, the BOJ and Japanese bond yields. So this chart here is showing you the longer term rate of GDP growth for Japan, and in the black line is the Japanese government bond 10-year yield. And that little lighter blue segment there is based on IMF forecasts. So really the key point in this chart is that the 10-year bond yield tends to trade in line with the 10-year pace of GDP growth. And with even just looking at the current pace of growth, let alone the pickup that the IMF is projecting, it tells you that Japanese bond yields should arguably be more trading around 1%. And maybe if the Bank of Japan wasn't, still proceeding with its easing program, they would be trading around there. But really key development happened at the latest BOJ meeting. And as I note here too, by the way, there's a bit on Bloomberg, which I talked about that. But the what they did was, so if you look at this chart here, where volatility in the 10-year has just been, murdered. It's been trading at a very tight band, and basically what we can construe from how the market's been trading is that the BOJ had been running a 10 basis point cap on yields. Now in the latest meeting, they actually explicitly said that they're going to widen the band from 10 basis points to 20 basis points. Now, if we take a little bit of a leap in logic, or a little bit of a thought exercise, if they come up to their next meeting, or a future meeting, say a month or two from now, and say we're going to widen that trading band from 20 basis points to 30 basis points, then at that point the market's going to cotton on fairly quickly to the idea that they are, progressively allowing the 10-year yield to go up. And you know, basically that would be confirmation that they're tapering, and you know, the risk there is that the yields do push up towards that 1% level, and if they did that in a short space of time, that's going to drive a lot of volatility across global bond markets. But, you know, it does make sense, you know, just thinking about it, does make sense for them to actually let the 10-year go up a bit, because, you know, if you think about it at the moment, the yield curve is very tiny in Japan, and you know that actually makes it hard for banks to make a profit in it. And you know, if you could argue that if the 10-year yield was a bit higher, then the banks there would have a bit more incentive to lend, and so you know that would probably actually have a more uh, meaningful impact on the economy than just, you know, having the 10-year at a low level, which it's you know, not entirely clear how useful that is. But anyway, I will leave it at that. And if you like this, make sure you subscribe to the channel so you don't miss out on any future updates. And you can also subscribe to actually get this report in your email box. I'll put the link in the comments as well as the video description.